Good day, everybody. Chris Erline here of REAP Financial coming to you with today's Wealth Report. It is Friday, July 25th, and I want to give you a quick update. As your team of advisors here at REAP Financial, our job is to cut through the noise and bring you the really important stuff that impacts your wealth and your future. And let me tell you, there's a big one that I want to inform you about. Many of you have heard, just this past 4th of July, significant legislation was signed into law. They're calling it the One Big Beautiful Bill Act, or the OBBB. This isn't just some tweak. It's a massive, nearly 900-page piece of legislation that's going to reshape how we think about taxes and spending in retirement for years to come. What I want to do today is just give you a quick rundown on the tax parts that really matter to you, our sophisticated clients, those of you that have significant investments and savings. In future weeks' wealth reports, I'll dive deeper into more specifics and other important provisions. But today, let's just hit the highlights. First off, just a quick heads up, some of this law actually kicks in before it was even signed, which is pretty common with these big bills. The biggest news in the OBBB is that a lot of what we've become accustomed to from the 2017 Tax Cuts and Jobs Act, which was previously slated to expire this year here in 2025, a lot of it is now permanent. And this is big for long-term planning. So what does it really mean for your money? Let me break down a few things here. When it comes to individual tax rates and tax brackets, there is good news. The individual tax rates and brackets we've been using since 2017 are now locked in for good, along with their inflation adjustments. So for planning purposes, this means more predictability for your personal income taxes, which is always a win. Now, when it comes to the standard deduction, we've gotten used to this beefed up standard deduction rate that went into effect 2017. That is now also permanent, and it includes its inflation bumps. On the flip side, personal exemptions are officially gone forever. And this just highlights why we put so much emphasis around planning around your income, your deductions, and why that's more important than ever. Now, there's a new twist. There's this new thing called the senior deduction. It's a temporary senior deduction of $6,000 for folks over 65 and over. And this is starting here in 2025, and it's going to go through year 2028. So what this is this provision aims to adjust income taxation for certain retirees. However, this is where it gets a little tricky. It starts phasing out pretty quickly after your modified adjusted gross income climbs above $75,000 for you single filers and $150,000 for married couples filing. So for many of our higher income retirees, this effectively introduces a new consideration for your tax planning. And don't forget the existing rules for including Social Security benefits in your gross income. So you, the CPA, and your advisor throughout the year will be doing both calculations. And as I mentioned in one of our past wealth reports, this bill did not directly eliminate tax on Social Security. Although it may for some lower income individuals, we still have to factor in taxes. When it comes to state and local tax deductions, it's called SALT. This is a big one for many of our clients. So for 2025 to 2029, the SALT deduction cap jumps from $10,000 all the way up to $40,000. So when you think about your property taxes, if you've got a highly appreciated home in a nice area, you've been limited on how much you can deduct. So that has gone up dramatically. And this cap will then creep up by 1% each year from 2026 to 2029. But then again, after 2029, it comes back down to $10,000 unless Congress steps in again. So I guess the good news is that earlier proposals to eliminate state workarounds for the SALT cap did not make it into the final bill. Many of our families give charitably, and there has been some changes around charitable giving. So for those of you that are non-itemizers, starting in 2026, if you don't itemize, you can now deduct some charitable contributions above the line, up to $1,000 for singles and $2,000 for married couples. This is now permanent. And this is important because so many Americans out there, they give charitably throughout the year. They take standard deduction, so they're not itemizing, and they don't get any sort of charitable deduction. So this change is favorable for those that are non-itemizers. There's also some new limits for high income donors. So after 2025, if you itemize, you'll only get to deduct charitable contributions that exceed 0.5% of your adjusted gross income. So if your AGI is $200,000, what that means is that first $1,000 in donations won't be deductible. And if you're in the 37% tax bracket and itemize, your tax benefit from charitable giving will be capped at 35% of your donation, not your full 37%. So for those of you that still carry a mortgage or mortgages, there have been some changes around this. So the 2017 limits on mortgage interest deductions, which cap interest deductibility on the first $750,000 of the home acquisition debt, are now permanent. This could be a nice perk, but some mortgage insurance premiums will also count as mortgage interest after 2025. And just a reminder, interest on home equity loans is only deductible if you use the loan to buy, build, or improve the home. When it comes to the alternative minimum tax, this is what a lot of our clients get hit by when they sell a home. They do a large Roth conversion, or let's say they sell highly appreciated stock. There's great news here. The significant changes from 2017 that drastically reduced the number of people hit by the AMT are now permanent. So all that means is continued relief for many of our clients who are used to getting caught by this tax all the time. When it comes to your legacy, I'd say there's a big win in this bill. Not only did the OBBB make the increased lifetime estate and gift tax exemption permanent, but it actually raised it even further. The 2017 law actually doubled it to $10 million, and by the end of 2025, with inflation, it will be $13.99 million per person. Now that was slated to be cut in half here at the end of 2025 if legislative changes weren't made. Now the OBBB permanently boosts that lifetime exemption to $15 million in 2026 with future inflation adjustments. So for many of our ultra-affluent clients, this is a big opportunity for smart wealth transfer strategies. So at the end of the day, the One Big Beautiful Bill Act has brought some significant changes, and it's presenting both new considerations and some incredible new avenues for optimizing your financial situation. My team of advisors and many of the CPA and tax attorneys that we work with are already deep into the details on this, working on customized strategies for each of your unique situations as they come up through the years. In weeks and months to come, I'll be sure to keep you, our beloved clients, posted with more updates and detailed analysis as we digest everything. For now, just let all this sink in and rest assured that we're actively working to protect your wealth and optimize your financial future. We thank you for your confidence.